What's going on, everybody? I'm Femi the Agent.
And I'm Femitherealtor.
And I'm Eric Braun.
Here we are on another episode of Sneakers and Real Estate. If you guys follow me, you know that I love sneakers. Buy them, wear them, trade them, the ones that I don't wear. And here we are on another episode. So today we're going to be talking about the Jordan 7 Doernbechers. So this particular sneaker was made in collaboration with the Doernbecher Children's Hospital and Jordan Brand. This particular pair was made by a 10-year-old named Damian Phillips. Damian Phillips has hemophilia, this severe bleeding disorder, and he also has a love for guitars. So like if you see the bottom of the sneaker, this has a lot of great detail to it. So it has the guitar on the bottom, and it also shows him wearing the Jordan 7s. You know, the Doernbecher Jordan sneakers are, for me, really near and dear to my heart. I love what they're doing with this particular shoe, or the collaboration. You know, all the money that gets raised from the Doernbecher sneakers with Jordan goes to a charity. Actually goes to the hospital, and I think that they've raised over $20 million. Don't quote me on that, but I think it's like 15 or 20 million. So anything Doernbecher I definitely like, and they're super limited. If you don't have a pair of these, you definitely need them. On the back, you have DJP, so it has Damian's letters on the back of the shoe. And like I said, he designed it, the colors he picked together, and also on the bottom of the shoe, you have the clear translucent bottom. So like I said, really dope shoe. You definitely need a pair of these in your life. If you can find them, I would definitely say grab a pair. If you're a sneakerhead, you definitely need these in your rotation. I don't know if I'll ever wear these. I might wear them, I might pop them out, I'm not sure yet. We'll see. But definitely get you a pair. And we're gonna go to real estate now with my son.
All right, so how much money do you have to have saved up in the bank to buy a house?
So it's obviously a common question. It depends on what price range we're talking about. So what's run-of-the-mill?
Average sales price, if you're looking Nassau County, I'd say like 500,000.
Okay. So if I do $500,000 house as an example, there are a few different loan programs. So let's first start there. The two main types, you have FHA and conventional.
Right.
If you're a veteran, that also opens up the door for a VA loan, which on VA loans you can do 0 down, right? You still need money for closing costs, but you can do 0 down.
Well, you also, sorry to cut you off, you need money for when you're going into contract. So just so everybody understands, folks, if you're a vet, it is pretty much 100% financing on the deal. You don't need any money, but to go into contract, because we are in the state of New York, you do need some money down to bind the contract. There has to be some sort of monetary value there. Mm-hmm. So, whatever house that you're buying, if you put down 10 or 15,000, you'll end up getting that money back at the closing table, just so that everybody understands.
Or it'll go towards your closing costs.
Or it can go towards your closing costs.
You still need money for closing costs,
right?
But the bank is going to give you 100% of the money for the purchase. Okay. So that's VA. If you're a veteran and you have more questions with that, you can contact either of us. The main two loan programs other than that are FHA and conventional. Okay. FHA, you're able to put 3.5% down. For the most part, conventional loans require 5% down. Okay. There are certain conventional loans that you could do 3% down, but let's just keep it super simple. You got 3.5% FHA, 5% down conventional. So we're using $500,000 as a number.
As an average sales price. Mm-hmm.
3.5% of that would be $17,500. Okay. So if you're getting an FHA loan, you need $17,500 for your down payment on a $500,000 house.
And what about the closing costs?
Closing costs are normally anywhere from 3 to 5% of the purchase price as well. So let's go right in the middle and say they're 4%.
4%. Okay.
$500,000, what's 4% of that? $20,000. Okay. So you got, keep it very simple, you got your down payment at $17,500, your closing costs at about $20,000. That brings you to a total of $37,500. That should cover you for a $500,000 house if you're doing FHA. Conventional, it's going to be a little bit more because they're going to ask for 5% down for the most part.
Right.
which 5% down of $500,000 is $25,000.
Okay.
Okay, so that's your down payment. Closing costs are going to be the same.
Roughly around the same, yeah.
That's $20,000 for closing costs.
Okay.
So then in that scenario, you're going to need $45,000.
$45,000. Okay.
So I would say anywhere from 35 to 45 is a very, very good thing, or a good target to shoot for as far as savings goes.
Okay.
Now, closing cost, just to kind of clear up some confusion, closing costs, not to get super into detail, but it's not exactly 20,000. It's not a flat thing, right? So there's multiple things that are included in closing costs, but we always say, just to give you an estimate, 3 to 5% of the purchase price. And on that number, it was just coming out to $20,000. Whereas your down payment are flat things. That's 3.5%, 5%, depending on the program.
Right.
So depending on the area, depending on how much the taxes are on the house, those are all things that are going to change how much your closing costs are. But I would say anywhere from $35,000 to $45,000. If you got that saved up right now, you should be looking.
Okay. And also for those who don't understand who would qualify for FHA, if you haven't owned a house in the past 3 years, you would qualify to fall under the FHA criteria. FHA normally is like the first-time home buyers program, or you hear so many people say that. So if you owned a house, you sold it, and this was all done 4 years ago, then you would qualify. Am I correct?
So there's a lot of misconceptions when it comes to FHA. A lot of times it's used as and marketed as a first-time home buyer program.
Right.
The main thing that you have to realize is you can't have two of them unless they're 100 miles apart. So for instance, I have a Florida house that I bought 3.5% down, FHA, however many years ago, and I'm moving to New York. I can do FHA again, as long as you fit into a few other boxes. But for the most part, just to keep it simple, you can't have two FHA loans at the same time.
Right.
Conventional, doesn't matter if you're a first-time home buyer or not, you can do 5% down.
Right.
So, and when determining which program to go with, down payment is only part of it, right?
Right.
There are other things that are going to sway us, either conventional working better for you or FHA working better for you. The main thing is credit score. Generally speaking, if somebody's in the 600s, FHA is probably going to be a better route.
Okay.
Conventional, if somebody's in the 700s, conventional is going to be a better route. There's a few other things, the way income is calculated, if your employment history, there's a lot of differences between the two programs, but that all comes down to the loan officer to figure out what program best fits you and why. And then they actually explain that to you, which is uncommon in our industry, unfortunately. But
which is why you need to talk to my guy Eric, because they're going to look at your situation and see what actually makes the most sense for you, and that's the program that they're going to drive you to go towards. They're not looking to try to penny pinch and try to make the most money that they can make off of a deal. They're actually looking out for your best interest and to help, just like my son said.
And we're going to take the time to explain all of the options. So whether that's FHA versus conventional, or 5% down versus 10% down. Right. Maybe you have more than $45,000. Do you want to use all of it? Do you want to keep some in your pocket? Maybe it depends on the property that you find. Maybe Femi shows you this awesome house with a lot of potential, but it needs a kitchen, you know? And we were originally planning on doing 10% down, but because it needs a kitchen, you want to do 5% down to keep some money in your pocket.
Hold some of your money.
So that's going to be the conversations that me and you are going to be having, and then you're going to be finding and doing all the fun stuff with Femi, which is why normally people like Femi more than me. But so if you have any questions when it comes down to the numbers, that's always going to be a question for me, and we'll go over that together.
Yeah, that was the question I was going to ask you. How, like, what's the minimum or like range of credit score that people need to have in order to be able to look?
So good question. Also another common question. So we went over down payment. What about credit? Technically speaking, you can go as low as 580 on your credit score, which...
There's a lot that goes into that, folks. Don't think you just got a 580 and you're going to get a house. Listen carefully.
And FHA allows you to go as low as 580 with 3.5% down. They actually allow you to go lower than that with what they call compensating factors. So either a higher down payment, a lot of money in the bank, low debt to income ratios. So the answer is it's 580, but you can go lower with higher down payment. Conventional loans, they're strict and they say no lower than 620. Even if somebody has a 620 credit score, that doesn't mean conventional is the best program for them, though. So that's gonna, again, we're gonna have that conversation
he's gonna have with you
of what fits you best. But just bare minimum, I would say 580. If you want to do minimum down, you can go lower than that if you have more down.
Yeah, and the higher the credit, the better deal you get. So
yeah, and that's like when somebody comes to me and they have a 580 credit score, the first thing that I'm trying to do is figure out if we can help them boost their credit. Okay. Right? We don't necessarily, like when I run your credit, we don't necessarily have to go with that score. If I tell you to pay off X, Y, and Z, and I think we'll have a better score in a month from now, we can use that higher score. And a lot of times that's what I'll do with somebody with challenge credit, right, is teach them how to get higher, because the higher the credit score, not only is it easier for us and easier file in general, but also you get the better terms, which again, we're always trying to look out for to put you in the best position possible.
Nice.
I have a client right now that's doing, she has a 540 credit score, and we're still getting it done because she's doing 50% down.
Oh, okay.
And even at 540 credit score, she's still getting a rate in the threes. Nice. She's like, so when I say more favorable terms, there's so many other factors besides credit. Right. So I don't want to get too hung up on that. But generally speaking, to answer your question, we're going to take a look at it and figure out if it's time to act now, time to fix your credit and act a little bit later, using everything to make that decision.
And then also, if, for example, if we are going to contract on a house and we're not going to close, let's say for 3 or 4 months, mm-hmm, and your score right now is not at the highest, once we get into the contract, we have time to, Eric has time to help you get the scores up, correct?
Correct. And we could do what's called...
And I say we because we're a team.
Yes. We're going to all be communicating together throughout the process, but we can even do what's called a rapid rescore. So a lot of people come to me, they say, I run their credit, pre-approve them, Femi finds them a house, they have a 680 credit score. I say, Mr. Buyer, if you get to a 720, here's what opens up for you. Here's how you get to a 720.
Right.
They're like, Eric, I found a house. Right? So
which is usually what happens.
Femi found...
I work pretty quick, folks.
Yeah. They found me a house. I'm ready to go. We spoke about that 720 credit score option. Let's try and do that. Okay. Here's what you need to pay off. Get me proof that you paid it off. And we can actually do what's called a rapid rescore, which is when we go to the credit bureaus directly with right, that proof that you've provided, and they update your information right away. Within 48 hours. Oh, 48 hours. 48 hours to 5 days, depending on their turnaround times. But instead of waiting 30 days for that information to reflect,
we can get it back.
We go and go the extra mile, get the rapid rescore, and get that credit score back quickly. Yes.
So you see a lot of the different things that we can do, folks. A lot of the bigger banks, I don't know if they're doing any of these things or even taking the time to educate you and to look to see what's going to be the best case scenario for you. So for me, I always try to work with people that I know are going to take the time to educate you and are also going to take the time to see what's going to be the best case scenario for you. Because at the end of the day, if I can help you save money, I'm always going to try to. I'll give you my advice. If you take my advice and trust the process, it's going to work out better for you. If you don't, all I can do is just put my hands up and step back. But I'm always going to try to do what I can to help and, pretty much in your best interest to listen and trust the process.
100%.
If you have any questions regarding real estate, you can give me a call, hit me up, shoot me a text, a DM. If you're behind on your mortgage and you're not sure who to turn to, you can give me a call. I have people that I work with that I can help put you in contact with, and we'll try to see what's going to be the best case scenario for you. If you're looking to buy, if you're looking to sell, if you're not sure if right now is the best time to sell, you can reach out to me and, I'll go over everything and try to help you.